right, we're looking at these proposed guidelines. These are draft guidelines from the Reserve Bank of India, which have seemed to spook the markets a bit when it comes to PSU banks and lenders like REC, PFC. Let me first pull up those counters for you to give you a sense of what I'm talking about. Then the Nifty PSU Bank Index down over 3% right now. A whole host of these stocks responding quite negatively. PFC is down 11%. REC also down in the double digits, nearly 10% down. So now here's what's happened. This is a set of proposed guidelines which say that the standard provision for under construction projects has to be increased significantly from the current 0.4% to 5%. What exactly is it? Vishwanath Nair and Harsh Saita joining me to just break this down a little more. So, guys, let me start with you, Vishy. First of all, this is a proposed guideline. This is not something which happens right now.
That's right. So,
what is the guideline? What is the rationale for it?
The rationale is simple. Project finance is finally taking off in India again after a period of project finance where we saw big mistakes being made by banks, and then the subsequent NPA cycle that followed. The RBI is starting to take measures which will protect the bank balance sheets. Having said that, what this will lead to is higher provisioning upfront. When they say standard asset, it means when you're disbursing a loan, you need to make that provision upfront, 5%, which is higher than the 0.4% as you mentioned earlier. What that essentially does is it reduces the amount of profitability that you have on those projects, on those project finances, on the project loans. Banks as well as large NBFCs like REC and PFC have been actively involved in the project finance business. REC, PFC specifically. Banks like SBI, ICICI are all big shots in this space. So obviously you are seeing some amount of impact coming in for those lenders. The other important thing that is part of these draft guidelines is that whenever you're talking about a consortium of lenders who will come and take over these loans, essentially you cannot have any lender have less than 10% share in that loan. This was because in the last cycle we saw a lot of bankers coming in with 1 to 5% of participation in a project loan, and then when the project went down, all of these lenders became part of the resolution process, and that really created a lot of confusion. So at this point in time, a maximum of 10 lenders can participate in one project. Likely lesser. That will ensure that there are fewer people who are ensuring the recovery of the loans whenever things go bad. I'll let Harsh explain what is exactly happening in terms of the financial impact as well as what's up with the stocks.
Yeah, absolutely. So Vishy, it's one piece that that one needs to look at also is it's going to be a phased implementation, if at all this is implemented firstly, because it's in draft yet. It's going to be 2% in FY25, 3.5% in FY26, and then thereafter 5% in FY27. Of course, I think the key impact here is will this therefore lead to a problem with regard to reinvestment of profit and therefore hurt capital adequacy ratios, because this will definitely impact profitability in FY25. Little bit less, maybe more in FY26, and thereafter real impact FY27 onwards, and therefore that may impact growth and capital adequacy, both of those. Of course, including margins, because you'll require higher amounts of capital, and therefore that will have a spillover effect. What Bernstein seems to suggest is this could impact profitability by as much as 50% on certain projects, of course, but as much as 50%. So that's probably leading to the kind of sharp reaction on the stocks today.
So to put this in perspective, basically seeing that project financing is picking up, RBI doesn't want another, IL&FS kind of a mess. So it's a preemptive kind of a preparation, but it's only a guidance right now. Would banks be in a position to actually adhere to this if these guidelines become rules?
So essentially what that means is that fewer banks will take up fewer projects. That's the end of the story. Even today, project finance is happening in the economy, but that money is not coming from the banking sector. That money is coming from private capital, from companies themselves reinvesting their profits into fresh projects, things like that. But going ahead, if these draft regulations become the norm, then you can see or you can expect banks going slower on project finance than what would have been initially expected. Just last quarter, the SBI chairman was talking about a very large sort of pipeline for project financing, and that sort of comes under question if these rules come into play.
Yeah, so that's the big story that is hurting the markets this morning. But over to you, Vishy and Harsh, for the other really interesting inside details that you guys are tracking.
Yeah.